Hey guys, just wanted to give you an update on yesterday's trade that we took after hours, and then also a position that we just took short right now. Uh, we got stopped out for an $85 loss at around roughly almost 2 a.m., which was a good thing. I wanted to also make this post to show you the importance of taking stops. We just took an $85 loss with a reward potential of $1,000. Now you have to know why you're getting stopped out of a trade, because if the trade isn't invalidated, you should still be in it. So basically, this invalidated the position, and it started forming a short trend. And good thing we were out of it, because that moved about 20 points against us. Now we ended up taking this short trade upon the short signal on the 5 minute. The reason we took this, I understand that we have 1, 2, 3 reversal pattern right there, where you had you had the high, the higher low, and then the breakout up there, signaling basically a long signal. But what we have to realize is that was basically an 8 point move that you should have capitalized on. If you didn't, then you're right now losing money on it. So if you took that long position, some of you might have taken it. You have to be very cautious with it, because you're going against fundamental and longer term technical biases. Now, fundamental biases, we have the Eurozone debt fears, which pushed the market down, and that's why we got stopped out. And longer term, we have this. What we were talking about was the lower high and then the potential break of this level. Now, the fact that we had buyers step in right there and move the market up higher, that showed buying support, in the sense that this this long trade could have been a good position to take. But upon that uptrend, we had pretty big selling pressure come in, and what we look for is a previous Heikinashi break, and then we usually try to enter in the direction of the break about like mid previous bar. So on this position, let's say we are at 10 points of potential profit, and right now we will move our stop above or below the entry price, so that this is a completely riskless trade now. This is a situation we try to be in every time. Right now, as you can see, we're 4 and 3/4 points on the money. What we will do is move our stop to two ticks below our entry price now, and the main chart that we use is the 5 minute chart, and we are basically going to try to trail this stop down to the point where it becomes invalidated. So what we're going to have is another bar form in between this bar, which will allow us to move our stop right below the top of that. But we're kind of moving this stop actually a little bit early, so we might get tailed out of this trade. But where you really, according to the system, where you want your stop is right there. If you want to be extremely conservative, you could move your stop um, below your entry price, since you're short, and now you're guaranteeing some of a profit, and you're guaranteeing no loss on this position. Now, the reason that, let's say, you want it above this level is because if you look at this on the 200 tick, that level is the previous swing high. Um, Now, the way we usually trade this, there's two ways to trade this. We're either going to go for the straight profit on one contract, or add a contract once we get the short signal. So I'm going to pause the video and let you guys know kind of what we do in real time, and I'll continue it, and then we'll go from there. All right, guys. So this is what we decided to do. Actually, we averaged up a contract at 82.50 um, at this swing high, and what this allows us to do is now we have a profit potential double what we were at earlier. And as you see, the risk, or the average price, barely moved to where right now we are moving our stop actually right above that swing. So you literally have a riskless trade with a profit potential that's very high on this position. We're 5 points in the money right now, which is actually $210. And back a few months ago, we would just secure this profit. But the key is to let your trades work out, be confident in your system, know you're going to take stops, and if you're exiting a position for a certain reason, make sure it's a good reason that's invalidating the trade. Because right now, I wanted to show you we on our 200 tick chart, we broke this level and we didn't sell off too much, and it looked like we were about to get a long signal right there. We consider this all along. So that's a long signal, that's a long signal. We want failure of long signals. So we want basically this long signal to occur and then fail. So we had a long attempt and then failure. So we want this to continue downward and not break out of trend. And what we consider to be a breakout of trend would be basically a higher high and a higher low. So this is what would consider us, you know, or let's say make us go to the long side would be a higher low forming, and then a higher high, a breakout of a previous swing. Now, as you can see, our first target right there at 74.50 is at 3 ticks below the day's low. So usually what we see, we usually like to see, we usually will see volatility increase, and we should be able to get that first target filled. Now, if we pull up here on the 200 tick, if we pull up, the rule is to add another contract. So that's what we're gonna do, is we're either gonna have those two targets, the first target get filled at 74.50, or we will have a long signal, a pull up, and then an ability to short this line. Again, I guess what I'll do is I'll leave this larger. So what we're gonna look for is to see how that level tests. 75.25 is the day's low. Which, okay, you see that was a pretty big move where we had 75.25 break, which was this low, and it sold off essentially right away. Now, we met that target at 74.50, I think it was. So what we're gonna do now is attempt to add another contract on the pull-up. Now, even if our stop right here was above the average price right now, we would have a riskless position because we just profited on the first contract, and I'm pretty sure that was at $200 because I think we staggered our targets at 10 points each. So as you can see, though, right now we have pressure to the downside. What we don't want to do, we don't want to just enter short right here. We're looking for the pull up and then the kind of the basing, and then we enter short. So what we're going to do is let this play out, and I'll continue the video once something starts happening or we decide to do something. Alright, we just tested that our price at 72.50, so I wanted to start the video again, and hopefully we'll get filled down there. Now, usually if you test price and you don't get filled like that, we'll go ahead and exit. But since we are looking to average up this position, we're either going to get filled out with a profit, or we're going to average up a contract once we get a long signal. Now, looking at this on a time scale, our stop, once this bar forms right here, once we get a closure of this bar, our stop will be above the high of that bar. Now, we trade out of three frames of 3 chart frames. We have a time chart, where our longest term chart is a day chart, and that's to get an overall direction of the bigger picture market. Then we're using a 60-minute chart, and then we use a 15-minute chart, which is right here, and then a 5-minute. We don't really use a 1 minute too much. Primarily, we see too many false signals on the 1 minute, so we like to stick to the 5 minute, and it's kind of the chart that we know best, so that's what we trade out of. Now we use the 15 minute to confirm sort of what we like to refer to as like midterm direction. As you can see, all these like swing highs and swing lows on the 5 minute was basically just a pretty massive sell-off on the 15 minute, and if you look at the 60 minute, that was just straight down. So what we try to look for is agreement among all the time charts, all the time frames that we use. And then the next chart we use is a 200 tick chart, which is our faster time frame. It's more of an execution chart. So those time charts, the 60-minute and the 15-minute, are more analysis charts. The 5-minute is a mix of analysis and execution, because we do execute 5-minute signals on there. This is what we use sort of to average in positions, average up positions. And to give you an idea, we're looking to add another contract. We normally wait for this pull up to occur, and then we wait for our short signal. So we might get a short signal down here, which if we're only at that low, because this is basically testing the previous low of the day, which is this level. We might add a position there if we get a short signal. And also that we use a 4 range chart. So what we look for on the 4 range chart is swing patterns, and then also